Okay, good evening. Tonight is Tuesday, February 5th, and we just did quiz 2, and we'll be doing tonight chapter 15. Announcements, group assignment 1, due next week at the beginning of class, which is 6:05. It's really disruptive to the rest of the class. People, get here late because of their assignment. They get here, 20 minutes late and in all that kerfuffle. So if you want your stuff to be marked, it's got to be in by 6:05. You already know that, but it's posted on lemma.ca, which is my website, and also CU Learn. Next announcement, I forgot to put it on there, but I just realized because I'm doing chapter 15 tonight. That's the last chapter that's on the midterm, which is the first week after spring break. So next week, this week I'm doing chapter 15. Then next week I'll be doing the first half of chapter 16, but that's not on the midterm. And then after spring break, there's the midterm, the first class. Then I do chapter 16, the second half of chapter 16 in the second class. And then quiz 3 is on chapter 16, 3 classes after that. So this is the plan about for the next 4 classes or so. Any questions at all about anything? Yeah. Oh, the formula sheet? Yeah, it's going to be one double-sided sheet. Put whatever you want on there. Anything else? Okay. How long is the midterm? 2 hours. Okay. And the most important thing to use for studying is the suggested exercises, which are posted on CU Learn. And by the way, on CU Learn, I finally figured out how to show the grades. So I should have, I got that done I think either after class last week or the next day. So I should have seen that fairly good. So no other management things. Okay, all right. So tonight I'm going to do chapter 15. And it's mostly qualitative knowledge. It's, I'll cover all the material in the slides, but this is a chapter, it's not a bad idea to read because, I can put it in the slide a certain way, but this is more of a text type of knowledge chapter, so this is one that's worth reading. Most of the beginning is about how do you go to the public markets and IPOs and stuff like that. Really, the only difficult part, and it's not even really that difficult, the only part where there's any math of any kind, except maybe a little bit in the cash offer and IPOs, but it's in rights offering. This is where most of in 15.8 is where 90% of the substance related to math and formulas, that kind of stuff is. So the rest is mostly qualitative knowledge. So far we've talked about, we look at a project, we analyze its cash flows, and then we decide, do we do it or not? Then we know that we need a certain amount of money, so now we need to go and raise it. There's many ways to get investment into a company. There's bank loans. There's the money of the owners. All kinds of things that you can do there. But when you come to bigger amounts, bigger projects, there's venture capital, and the textbook doesn't really talk about angel investors, but angel investors like the Dragon's Den are a subset of venture capitalists. Basically, it's not a textbook. I'm not going to test you on it, but if you're just curious, the difference typically between a venture capitalist and an angel investor is the angel investor is investing their own money, whereas typically venture capitalists raise money from investors and then they go invest in business. So Venture capitalists are more or less what you would call professional angel investors and or institutional angel investors in a way. But venture capitalists and angel investors work in very similar ways. They're private financing for new businesses or relatively new businesses. Nowadays, it used to be that venture capital would get involved almost from day one, but nowadays they tend to get involved at least until there's some proof of concept or some minimal success. And instead of venture capital being used more for startup funds, nowadays it's more used for not quite startup, but very early growth. Usually entails some hands-on guidance, and that's probably, when it comes to venture capital and angel investing, that's the most underlooked aspect of it. If a venture capitalist or an angel investor puts money into your company, obviously they want your company to succeed. So usually what happens is they don't just bring cash, and you'll see that a lot on Dragon's Den. They'll say, well, all I could really give you is cash, and so I'm not going to invest. Because the real value of a venture capitalist or an angel investor is that they come into your company and then they help you quite a bit because it's their investment too. Right? They want to see it work. So it could be that, if you're selling, I don't know, you want to sell into Walmart, then they'll have somebody that's got experience and that will help your company set that up. It could be, for example, that if you're in the technology industry, a lot of angel investors in the technology industry are themselves used to be entrepreneurs in that industry, and so they have networks of contacts. Remember, you hear that, especially even more in U.S. business culture than Canadian business culture. It's about the connections. Well, that's what venture capitalists and angel investors do. They bring the needed connections to the table. Then it's a question of exit for them. They're not perpetual investors. They're not people that put money in and leave it in for 20 years. The window for a venture capital deal is about 5 to 7 years. That means that the VC firm or fund that's investing in your company wants to see a clear path in your business plan where they'll be able to get their money back. Right? They won't just invest money in and then, yeah, the company's doing well, but they're not able to take it out. They need what's called an exit. Right? Exit has two main forms. The IPO is the most commonly known one. And so, venture capital invests into a company, they build it up to a point where, it's big enough, it's got enough revenue, enough cash flow to justify a stock market listing. And then that's how they get their money back, right? They invest, and then when it goes IPO, then their shares usually, they'll hold on to a little bit, but a majority of their investment gets cashed back out for them at the IPO. The other exit for venture capitalists is what's called a strategic acquirer. So it could be that, say, I don't know, I'll start up a chain of sporting goods stores, and then Canadian Tire will buy me or something like that. Or it could be that I'm developing a mine, so I'll have some investment capital, and then either my mining company goes public or it gets bought by another mining company. So those are the two types of exits you can have. There might be some other kind of oddball ones. They're not I'm not saying in all cases, but in 99% of cases, it's either IPO or a strategic acquirer. That's the exit for a venture capitalist. Many VC firms are formed from a group of investors. That's what I'm saying. Like I said, the line between angel investor and venture capitalist sometimes a little bit blurred. But sometimes what happens is you'll have, say, entrepreneur like the guys that started eBay, right? They know quite a bit about e-commerce and this and that, and so typically what entrepreneurs in their late career do, what at least a lot of what you would call serial entrepreneurs, people that have started different businesses that have lots of experience in a specific field. In their late career, it's pretty common for them to end up in venture capitalist funds. So they're the ones, like the people that have built successful companies in the past, that tend to get recruited by venture capital funds to evaluate which investments to invest into, and then once the investment is made, to mentor and to connect that company the best they can. Some large corporations have their own venture capital divisions. It could be, here's an example, a strategy, I don't know if they're still doing that, but they were doing that quite a bit last 10 or 15 years, is Cisco. People that make the internet gear, switching, routers, that kind of stuff. There's two things as a company. You can either do internal R&D and create new products like that, but what a lot of big companies do is they just let little companies do R&D, come up with new products, and then one of them has a great product, groundbreaking technology, this and that, they just go and they buy it. And so what some of these big companies do, the ones that have a kind of a constant, flow of acquisition, what they do is they'll, in a way, internalize that whole process. Well, where they'll fund new startups that are developing technologies that they're expecting to then later, the exit in that case is the strategic acquirer. It's just internalized within a company. Cisco is the one example I can think of, but it might be others. When you look at a venture capitalist, if you're in the US, there's tons and tons and tons of them. In Canada, we have a pretty weak, undeveloped market in venture capital. That's what a lot of business people kind of complain about. So it says choosing a venture capitalist. The reality is that if you're in Canada, you probably don't have that much choice. But what are you looking at? Financial strength. So the purpose of a venture capitalist is what's called deep pockets, right? If you need a second round of financing, do you think they'll have the money for it? Or if they make an investment for like a million in your company and they only have 10 million overall to invest, then they're probably not that deep. You want a company that's got at least 100 million, a billion type of fund size. Style. There's many different styles. Now it says, do you want a hands-on or hands-off VC? I guarantee you that in 90% of the cases you have a hands-on VC because it's their money they're putting in your company. It's not your money. So they're more nervous about your company than you are. And so, if you want to find a hands-off venture capitalist, I'd be very surprised if you could find one. They're pretty rare. Most venture capitalists tend to be, they're not like public market investors that invest into a company and don't read the annual report, don't go to the general meeting, that kind of stuff. But when a venture capitalist invests into a company, they really get into it and drive it as best they can. And most of the time, it's pretty rare that they don't ask for control. So when you go and you raise money through venture capital, the founder usually loses control of his company. Contacts, I've already given you that little speech about connections, and you see a lot of that on Dragon's Den, right? It's certain product, and then some of the dragons will be more interested in going into that deal because they know, oh, I know this person that I can connect them and instantly double the business or something like that. So like I said, that's the most underlooked aspects of venture capitalists, is that they don't just bring cash. And a venture capitalist or an angel investor that just brings cash, just an investment check, that's not a great deal. What you want is, you want to pick up somebody that has a lot of connections, a lot of experience, that's able to mentor you into the industry that you're in. And then the exit strategy, I've already talked about that. Now, next is, okay, so everything went well. We got we're 1 out of 100 or 1 out of 1,000 that did get funded by, did raise money. Things went well, built their business, and now it's time to go public. So public issue, the creation and sale of securities to be traded on the public markets. It says all companies on the TSC, Toronto Stock Exchange, come under the Ontario Securities Commission. So even if you might have a company that's say located in Alberta, what happens is when their shares are traded in Toronto, this is seen as if the company was selling an investment in the in the Ontario jurisdiction. So that's why anything that's traded on the Toronto Stock Exchange actually comes under Ontario law. But this is an oddball thing of Canada. It has to do with constitutional law, that in the Constitution, property rights are specifically taking out of the federal control and put into the jurisdictions of the provinces. And so it's the provinces that have the constitutional law to regulate property rights. And so that's why, there's been lots of, it would make so much more sense to have one national securities regulator, and that's what, most modern countries have. It's pretty rare to see a country where you have, like if you go and you, in the States, they don't have an SEC for every single state, right? They have the Security Exchange Commission, which is a national agency. And so in Canada, people have tried to, amalgamate, put together, have one national agency instead of the Ontario Securities Commission, the Alberta, the BC one. In Quebec, it's called AMF, Autorité Marché Financier, right? The Authority of Financial Markets. So when you're a company and you're issuing investments or shares or bonds, it gets complicated because you have to register your prospectus. You have with all the different provinces, even though they got a system called Passport that makes it a little bit easier, but it's a mess. But I just gave you a little bit of background why that is. But the OSC website is actually quite good because you can go there and get all the different rules and so on. So how do you go about doing an IPO? First, remember that the board of directors is elected by the shareholders, and they're the ones that take major decisions. Obviously, day-to-day decisions would be part of the management staff, CEO, CFO, president, that kind of stuff. But when it comes to a major decision like that, it has to be taken by the board of directors. You have then the issuing company prepares a prospectus, which that says red herring because it's preliminary, it's not quite approved. What happens is it's like you give a draft prospectus to the OSC, then they approve it, and then you distribute the real prospectus. You need to have a prospectus if you're going to sell an investment to somebody in Canada. There are a few exceptions to that. It's not covered in the course, but I'll just tell you quickly. It has to do with if you're small companies and you're going to raise money from people, you're going to raise couple, $50,000. You don't want to have to do doing a prospectus is, you got to have audits of your company, like you got to have lawyers involved, you got to write, all kinds of stuff. It's writing a formal legal prospectus is not something that's cheap. You're talking about something that's probably $125,000 at least in terms of accounting fees, legal fees, that kind of stuff. So they have some exemptions, and this is for what's called private investments. But there are very strict rules. For example, it has to be somebody that's a relative or a friend or something like that. It's the whole purpose of these agencies like the OSC and Alberta and all these things is to protect investors from getting screwed by companies. And so there's a lot of these laws, but there are, if you're just curious, it's called the exemption from prospectus requirement. If you're ever curious, you can look that up. It's on the OSC website. If you got a startup and you're trying to raise a little bit of cash here and there, You don't need to go the full prospectus because there's no point of paying $100,000 in fees to get a $50,000 investment. So that's why they have parts of the law to help these cases. They study the prospectus, and then they notify the company of required changes. They might be, we need you to give more risk disclosures or this and that. When the prospectus is approved, then in consultation with the investment bank or the underwriter, the price is determined, and then the securities dealers are able to sell to the public. There's two types of for equity. Actually, there's the general cash offer, which is just what you're used to, right? Company sells, it's an IPO. Company sells their stock. They give a share to somebody, and that person gives the money to the bank. You'll see a little bit later the details of that process. The other type of equity raising is what's called a rights offering. And that has to do with, you have a company that's already public, so it already has shares that are traded on a stock exchange, but that company needs to raise new capital. And so what would happen in that case is you would have what's called dilution, right? If somebody, say, had 10%, say you had $1 million worth of shares out there, somebody had $100,000 worth of shares, so they have 10%. If you go and you raise another $1 million, well, now they don't have 10% anymore, they only have 5%. And so the rights offering is, another expression you might have heard before is the right of first refusal. So the people that are already own shares in the company, they're the first ones that are offered the new shares for sale through this mechanism of a rights offering, and so I will show you how that works. Now, there's under cash offer, there's a couple of subgroups. There's firm commitment, best effort, and Dutch auction. The two main ones are firm commitment and best effort. Dutch auctions are very, very rare. The last one that I'm aware that actually happened was, I think Google was trying to do something fancy. But it's not something that's very common nowadays. The two main ones are firm commitment and best efforts, sorry. And it has to do with, if you don't sell all the shares at the IPO, who gets stuck with the leftovers? So if it's a firm commitment cash offer, the underwriter, so the investment bank, gets stuck with the leftover. If it's a best effort, then the investment bank tries to put as many of the shares into the market as possible at the IPO, but whatever is left over, they give back to the company. Now, there's that the direct rights offer and standby rights offer. Those two types of rights offering, don't worry about that difference. Not that important. Some of these other, shelf cash offer, and you can read about this in the textbook, but it's not that important. The next one that's important is a direct placement, or also called a private placement. If you look through the pages of Financial Post, one of these business newspaper, Ottawa Business Journal, another example. Excuse me. So a private placement is where there's an investment in a company and it's not something that's offered to the public. Typically, it's just one investor, or maybe a very small group, like 2, 3, 4, 5, and then it's just a direct deal with a company. It could be either equity or debt. So an example of a private placement would be you go on Dragon's Den and you get a deal there. That's an example of a private placement. Another example of private placement, like I said, you look in the newspaper, it will be, there's a hospital that's getting built, and then, or say a private hospital that's getting built, and then the teachers' pension fund bought, you know, 50 million of bonds of that company. There's quite a bit of that stuff that's going on. You're just not aware of it. Sometimes people will just, like I say, announce it in the newspaper, but this is kind of like the part of the iceberg of the financial system that is underneath the water and you don't quite see. You know, obviously you see stuff about public, but there's quite a bit of private placement going on. So when it comes to selling stock to the public, there's, like I said before, the IPO, but there's another expression you'll see, not that often, but it's called the season equity offering, meaning the season that the company has already been around. And this is where there's a company that's already public, but they need to raise more money. But typically, it's more done through a rights offering because that's more fair to the current shareholders. So what are underwriters? Underwriters are, remember that banks and all these other kinds of financial service company, they're known quite often as financial intermediaries, right? They're the intermediate person or the intermediate organization between two different things. In the case of, if you're talking about just a classic savings and loan type of bank business model where you have depositors, you have a little bank in a town and you have depositors and they deposit money in the bank and then the bank takes that money and loans it out to people for mortgages. Right? So there, the savings and loan institution is acting as the intermediary between the savers and the people that need the capital for a mortgage or a business loan or something like that. In the setup of going public, that financial intermediary is called an underwriter. And typically that's an investment bank, so it would be like Goldman Sachs, Morgan Stanley, those types of places. In Canada, it tends to be investment banking divisions of one of the big four banks. So, CIBC has their CIBC Capital Markets, and RBC has RBC Capital Markets, and they all have, usually they're whatever the name of the bank, Capital Markets. In Canada, that's the way that it works. So if you're one day looking for a job in finance, that's a group of companies to look at. Although I don't know how much they're hiring these days. There's not a lot of IPOs going on in Canada nowadays. So what does an underwriter do? There's a couple of different services, but here's the idea. Instead of, say you're a company and you're building bicycles, right? And you need investment for, you need, a big chunk. You need 50 million, 20 million. Well, you're not going to go to one investor at a time and say, can I get 100,000 from you? Can I sell, 10,000 of stock to you? Can I sell 15,000 of stock? What you're going to do is deal with the underwriter, and then the underwriter, which have, pretty big distribution networks, so their main one is they'll sell it. They got a seat on the stock exchange, and they'll sell it into the stock exchange. The other one is within a big investment bank like that, they'll also have investment clients, and so instead of just selling it to into the public market at the stock exchange, they'll also, if you got a company, say like Morgan Stanley, Goldman Sachs, stuff like that, they do an IPO, they're going to move a lot of their a fairly significant part of what they're selling. Instead of selling at the IPOs, they'll sell it to their clients that have investment portfolio with them. And in the past, this is an area where there's been quite a bit of abuse and quite a bit of shenanigans going on. Especially when you had the .com where it would really shoot up at the IPO. Whoever got the allocation of IPO stock, there was quite a bit of shenanigans and preferential treatment for special clients and this and that going on. So, but that's the rules have been tightened up a lot more. So there's a little bit less. But there was a time where that was an area in the market that was, there was quite a bit of I don't know, illegal, but certainly unethical behavior going on. I think maybe now they've strengthened the laws and made some of the things that were happening in the past illegal. So what the underwriter does is you go to them and you say, I want to go public. They'll sell all the shares. They're the intermediary between the issuing company and the public market. So what are some of the things that they do as part of this process? They formulate the method to issue securities. So it could be, are we going to do a stock offering on the Canadian exchange, or we're going to go directly on the Nasdaq? That the kind of strategy. What time of the year should we issue them? How much of the company should be put up to be available for the public? Like, what's the public float? Those kinds of issues. Most important part is price the securities. Right? They got the interplay, like I said before, of having I'm talking about modern times, having your own customers that are buying some of these shares gives you a certain feedback on how many shares you should bring to the market and at what price. Because you're talking to your clients and you'll know, I should be able to sell 100,000 shares or 500,000 shares. And based on that, you decide on the price. And deciding on the price is one of the most important things. Because if there's many ways that you can screw this up. Facebook is a great example. If you overprice the shares, and then after they go public, they just keep going down and down, well, it looks like you ripped off the people that bought it at the beginning. If on the opposite, you underprice, so you go into the IPO market with a price that's much, much too low, then what happens is the stock goes public, and so say maybe the company raises 10 million, and then on the first day of trading, boom, it doubles. What does that mean? That means that the company should have gone public, say, at twice the amount instead. So instead of the company getting that money, that would only get 5 million, the other 5 million of profit would have been made from the day traders at the beginning of the IPO. And in the .com in those days, the whole day trading thing, that's a lot of what that IPO stuff was. It was about buying it at 1 minute after it opens, and then holding it for the first day or 2 days, and then IPO flipping. If the investment bank prices the IPO shares correctly, there's no IPO flipping going on, and there's no, we went public at 38, but now our stock is worth 15, which makes the company look pretty stupid. Then what they do is they sell the securities, and so they'll sell it through the electronic systems at the exchange, and they'll also do price stabilization. So what that means is, say they go public, but the price, because people really hate to see a stock go down after it goes public. It looks really bad. And so what would happen is what they'll do is they'll step into, if the stock starts to fall back down, the underwriter, the investment bank, will step into the market to buy, to try to put a floor underneath the price. So that's what price stabilization could be called. A little bit of price management, but that's essentially what they're doing. Now, with very big deals, what underwriters will do is syndicate. And this is a concept that doesn't happen only in IPOs, but it happens in lots of things in finance. The purpose of syndicating is to reduce risk, right? Instead of one bank having to sell, say, 1 billion of shares, then what they'll do is you'll still have a lead underwriter, right? When you look at the prospectus for the IPO, you'll have like the main underwriter at the top, but then you'll have other syndicate partners. The purpose of a syndicate is to put a bunch of people together and to spread the risk among these different people. So an example then would be of a syndicate, not in this context, but a very similar context. Think of Dragon's Den. They're going to invest 100,000 into a company. Instead of one person investing 100,000, what they'll say is, just we'll go in two of us, and we'll each put in 50. And so what that does is that, or we'll go all five of us, and we'll each put in 20. And so what it does is it spreads the risk between the syndicate partner. Instead of one bank having the whole risk of the whole IPO deal on them, they spread the risk between other people. They'll still maintain a lead role, but what they'll do is they'll block, maybe you'll have the lead underwriter might take 20-30% of the deal, and then you might have a whole bunch of smaller banks that will take maybe 10%, 15%, 20%, that kind of stuff. And so that's what a syndicate is. Spread is how these people make their money. Investment bankers don't work for free. They need to get paid. So the way that they get paid is through what's called the underwriting spread. Now, it's easier to show you as an example. So what happens with an underwriting spread is this. You have three participants in an IPO deal, right? You have the issuing company, you have the underwriter, and you have the investor, the person that's going to buy the share. So what happens is, here you have, it's called BB Drum, is raising money in an IPO. They receive 22 per share, but the offering price is 25. So what's happening is this. The underwriter is selling the shares to the public at $25. But for every share that they sell to the public, for which they get $25, they'll give $22 to the issuing company. That difference there, the difference between the 25 and the 22, that $3, that's the underwriting spread. And that's how underwriters get paid for what they do. So let's look at this example. So it's really just taking the percentage of something. Remember that if you want to know the percentage of something, the percentage difference between two things, you just go, A minus B, A divided by B over 1. Right? That's the general structure of when you want to look at a percentage. So in this case, we want to look at the percentage difference between the proceeds per share. So that's what the issuing company receives. And the offering price is what the underwriter gets paid. Now, so you do -1 so that you end up with your percentage. So you have 25 is the offering price, 22 is the proceeds. So 13.64%. So that's a pretty nice business if you can have it. But it's very capital intensive because you're dealing with lots of money there. The other thing is that spread is going to be different based on whether you have a firm commitment deal or a best efforts deal. Remember that with a firm commitment, it's the underwriter that takes the risk, that not all the shares are going to sell at the IPO. Whereas with a best efforts deal, it's the issuing company that takes the risk. And so in a best efforts deal, typically you'll have a lower underwriting spread because the underwriter is taking less risk. If the underwriter takes the risk of doing a firm commitment deal, which says that, if you're going public with 1 million shares, but I only sell 800,000, I still have to pay the issuing company for that extra 200,000. And then what they do is, what investment banks like that do is they'll put those leftover shares, they'll put them into their inventory, and then they'll dribble it out into the market, or they'll sell them to their clients. Say again?
That calculation, 14%. 25.
Divided by 22 is not 1.1364? 25 divided by 22 should be 1.1364, right? So what's your question then?
Isn't 25 divided by 22
Maybe because the rounding on your calculator is not, do you see any, what's the digit after the 4? Yeah, it's probably just 1.136 that gets rounded to 1.14. I'll show you how to put, actually, how many people here would like to see how to put more decimals on the calculator? All right, I'll just show you individually after the course. It's pretty simple. So firm commitment, another word for it is a bought deal. So in other words, the underwriter buys the shares to be issued from the issuer even before the IPO is done. So the issuer sells the entire issue. The syndicate resells the issue to the public. Underwriter makes money on the spread. I've already explained that to you. And the syndicate bears the risk of not being able to sell all of the shares. This is the most common type of underwriting in Canada. So most of the time it's firm commitment. It's you don't hear of a lot of best efforts. We still talk about it. And then the next one was Dutch auction. And I'm not going to cover that because, I mean, in the last 10 or 15 years, there's only one that I heard that happened. So this is not, Dutch auction is not something that happens very often. The Dutch auction, it has to do with the pricing of the share at the IPO. Instead of coming up with a price, what you do is you say, everybody put in your bid, and then you just sort them down in descending order of their price. And so you just sell the shares to the highest bidder, and then the highest bidder, until you run out of inventory. But it's quite complicated to do, the mechanisms to do it, and it happens very rarely. Just regular underwriting, the firm commitment and the best efforts is what's common. And again, the firm commitment is even more common than best efforts. So here's an example of firm commitment. So when you do a question like this, it's all about figuring out, it won't say, in the title of the question, this is a firm commitment question. You have to read the question to see, am I dealing with a firm commitment or a best efforts deal? So it does say, you hire an underwriter who arranges a firm commitment underwriting and suggests the initial selling price is $28 a share with an 8% spread. So what proceeds mean is it's the amount of money that the issuing company receives, the amount of cash that the issuing company receives. So if it's a best efforts deal, if it's a firm commitment deal, and it says here that there's 50,000 shares available at the IPO, but only 48,500 sell, then the issuing company is still gonna, the underwriter is still gonna have to buy all the shares from the issuing company, pay them for all those shares. And then, like I said, what they'll do is they'll keep them in inventory, and then they'll dribble them out into the market, or they'll sell them to somebody else. So you have 50,000 shares. So when you do one of these questions, it's about, am I using the 50,000 or the 48,000? That's based on whether it's firm commitment or best effort. Then it says they're going to receive $28 a share. but there's an 8% spread, meaning that they're going to keep 92% of the money raised, and then 8% is going to go to the underwriter. So you just multiply that together. So the issuing company receives a check for $1,288,000. The next one is best efforts, and so they'll say, yeah, we're going to try to sell everything, but if we don't, that's the problem of the issuing company. And so I have an example here again. Is it the same? If you look at this example here, if it was a best efforts underwriting, then the company would receive money only for 48,500 shares, and then they would get the extra shares that didn't sell back. So here's an example. So you have Wexford Industry is offering 60,000 shares on a best efforts. And so since there's only 48,250 that sold, then the company is only going to receive the money for 48,250. And on this previous example, this was the offering price, and so the whole thing was the proceeds per share, right? 92%. If you have an underwriting spread of 8%, then 92% of the offering price goes to the company. In this case, we're just given directly what is the underwriters agreed to pay 35 a share. So that's the proceeds per share to the company. So you don't need to do this adjustment because instead of just giving you the offering price and the spread, in this case you're just told what the proceeds per share was. And because it's a best efforts underwriting and they only sold 48,250, that's what the company is going to receive, and they're going to receive the proceeds per share, which is 35. Which is $1,688,750. So what are the different costs of issuing securities? And there are many costs. It used to be that everybody wanted to be public. Nowadays, companies, the pendulum has swung the other way, and there's companies that are staying private. It used to be that a company would go public as soon as it was able, as soon as it was good enough to be public. Nowadays, companies will stay private. Companies that would have gone public, say, in their, second or third or fourth year of existence, now tend to stay an extra 2, 3, 4, 5 years into the private market before they actually go public. The reason being that it's extremely complicated and it's extremely costly to be a public company. You have lots and lots of different fees. First of all, when you do the issuance, you have to pay the spread. You have other direct expenses, so legal fees, filing fees. That has a lot to do with that prospectus. Like making a prospectus to go public is not a cheap thing. This is like a $100,000 plus type of project. You have indirect expenses, especially the management time. So you might have management used to be very involved in talking with customers and following market trends, keeping an eye on competitors, looking at trying to improve the input costs, all that kind of stuff. Now all of a sudden the company's going to go public. The 6 months before the IPO, the CEO, the CFO, and all the C whatever, that's all they're spending their time on, and sometimes they just forget that they were driving the business in the first place. So it can be quite a bit of distraction for management of a company, the process of going public, because it's so, there's so many things to do, there's so many steps, so many different people to meet. You got to meet accountants, you got to meet lawyers, you got to meet underwriters. You got to do a road show to promote your company. It can be quite distracting for management. Now, the cost of issuing securities says abnormal return is a price drop on existing stock. That line there is a little bit confusing. What I would say about abnormal return, and it can be a cost, if you have a bad underwriter that underprices the security on purpose to make sure that they sell everything, but then say your share goes public at 10 and then it shoots up to 20, well, they really should have gone, say it shoots up to 22, well, they really should have put it at 20. The company would have had twice as much money in their pocket for selling the same amount of percentage of equity in their company. Instead, if the underwriter misprices the IPO, then the money that should have been the issuing companies ends up being made by the flipper day trader people that buy it at 10 in the morning and sell it at 22 at night. So that's a form of fee if you can look at that. I guess that's underpricing. That's what they put that underpricing. Over allotment. This is something that underwriters will do sometimes. What it says is, if the underwriter doing the IPO ran out of shares to sell, like this is say like a very high demand IPO, then in sometimes some of the deals between underwriters and issuing companies, there's going to be an over allotment saying that the underwriter is allowed to sell maybe 5% more of the shares, or 10% more. Say the IPO is 100,000 shares. There might be the underwriter can sell another 5,000, 10,000, something like that. Typically on the order of 5 to 10% of the volume of the deal. That if things go very well, then the underwriter has the option, but not the obligation to be able to sell a couple more shares. So that's what over allotment is. Okay, so here's a nice place to take a break. Okay, time to continue. So now I'm going to talk about rights offering, which is really the main substance, anyway, math-wise for this chapter. The rest, like I said, is mostly qualitative type of knowledge. I strongly suggest you have a quick read of the chapter. It's one of them that might be interesting and useful. So rights offering. This is once you already have a company that's already public, already has shares out there, and they need to raise more money. And so if they just sold the shares to new strangers, that would be unfair to the current shareholders because they would get diluted. Right? Somebody would have, say, 10% before, and then now they would have less. And so the mechanism of rights offering is a way to raise new money for the company, but while being fair to the current shareholders. So the mechanisms is you specify the number of shares that can be purchased. So a right, basically the way that it works is for every share that you own, you receive one right. And then, depending on, you'll see the mathematics in a bit, depending on what the prices are, how many shares are getting sold and all that, then you're going to need a certain amount of rights to buy shares at the rights offering. And the way that it works is the purchase price of the shares has to be lower than what the current market price is. Because if I have, say, I want to do a rights offering, and shares are traded on the stock exchange right now for $25, and I do a rights offering at 25, nobody's going to buy my the extra shares from the company because they could just go and buy them on the market, and they'll think, oh, maybe the market might go down a couple of points, and so I might be able to buy it at 24.50, 24. So the way to motivate people to buy your shares when you do a rights offering is to sell those new shares at a price below the current market price. And then what you do is you give one right for each share that's already out there to buy those new shares at the lower price. But you're going to need a certain number of rights for each new share that you buy. You'll see the math in a second. And then there's an expiry. So, the rights offering is good for 30 days, 60 days, that kind of thing. Rights are separate from the stock. It's similar to a strip bond where you think of a bond where you have the principal payment and the coupon payments. And what dealers have done in the past is they just take, they split the two and they'll sell the principal bond, the principal of the bond back to somebody, say, that doesn't want the money back for 10 years. Then they'll sell, say, just the coupons to somebody that needs, say, income every month or every quarter. So that's an example with the bonds where you have two securities, but they're related to each other, but they're actually separate. And so with rights, it's the same thing. A right gives you the right, it sounds a little bit redundant, but to buy something at a lower price than what you can buy currently in the market. So that has some kind of value in itself, right? If shares are currently trading at 25, and I give you a piece of paper that says you can buy those shares for 20, how much is that piece of paper worth? No, 5, because it's a piece of paper that gives you the right to buy something for $20 that's worth 25. Right? All right, put it this way. I give you a piece of paper that says I will sell you a $20 bill for $10. How much are you willing to pay for that piece of paper? Exactly. So that's the mechanisms of rights. The actual rights are a separate, that's what that last bit there. Rights usually trade on the same exchange as the company stock. They're an actual security. They're an actual piece of paper that has value in themselves, because this is a piece of paper that gives you the right to buy something at a price that's below what you could buy in the market right now. But there's a time frame. They expire after a certain amount of time. So what's going to happen is current shareholders are either gonna exercise the right and buy the shares so that they have to put in new capital into the company, but they'll maintain their percentage ownership. But that piece of paper is tradable. If the current shareholder does not want to exercise the right, then you can just sell it to somebody else, and then he's going to use that piece of paper and then be able to buy that $25 stock for $20. So let's look at there's a little bit more. There's one more page there. The price specified in a rights offering is less than the current market price. I've explained to you the mechanisms because you want people to buy it. So the subscription price that it's called is going to be a little bit lower than what the stock's currently trading at. The share price will adjust based on the number of shares issued. If there's dilution or there might be, you'll see how all the math happens in a sec. And the value of the right is the difference between the old share price and the new share price. So let's look at an example. It's a lot easier to explain by example. So you have a company that wants to raise $10 million. The subscription price is $20 and the current stock price is $25. The firm currently has 5 million shares outstanding. So if they want to raise 10 million and the subscription price is 20, that means they're going to have to sell 500,000 new shares. It should say new shares here. So before this deal, the company had 5 million shares outstanding, And after the whole rights offering is completed, the company is going to have 5.5 million shares outstanding. So the first thing you want to know is what is the change in shares, and that's the amount of money that you're raising divided by what the subscription price. Not the market price, not the 25, the subscription price, which is 20. And so that means that to raise 10 million at $20 a share, you're going to need to sell 500,000 new shares. So how many rights will it take to purchase one share? So every 5 million share that existed before, so there's 5 million old shares, you're going to receive one right for each one of the old shares that you have. And there's 500,000 new shares that are sold, meaning that you got to put in 10 rights plus $20 to get one of these new shares. So the formula is just the number of rights you need is the number of shares you had before divided by how many new shares you're going to have. In that case, it's 5 million divided by 500,000, so it's 10. And then what is a right worth? What is that single right that you receive worth? If you don't exercise it to buy new shares, then it would be pretty stupid to just let it expire because you're just losing money. What you can do is, if you don't want to invest more money in the company, you can just take that right that's given to you from being a previous shareholder and sell it to somebody else that's going to use that right to go and buy shares. So what is that right? Remember that I told you that that's separate. That's a separate security, a separate piece of property from the stock. Sorry, from the stock itself. So the formula is the value of one right, and it's R0, meaning the value today, as in P0, price today. So P0 is the market price today, PS is the subscription price, and it's divided by N plus 1. And so if the current market price is 25 and the subscription price is 20, then each one of those rights, which is, you need 10 of those rights to buy one new share at $20, each one of those rights is worth 45 cents. So let's do an example. So in this case, you're raising 16 million. And the subscription price is $100 a share. And so you're gonna sell $160,000 new shares. And so how many rights will you need to buy one of these $100 new shares? So you receive one right per old share that you have. And there's going to be 160,000 new shares. So there the units are rights at the top, new shares at the bottom. So that's 5. You're going to need 5 rights per new share that you buy. Next, let's do a value of a right. Now, this example is a continuation of the previous one. The numbers are the same. You have 800 shares currently. Oh, yeah, sorry.
So, use one right per share, is that ever gonna be different? Is it ever gonna be, for some reason, you need two rights per share?
No. What changes is, what you do is I'm just spelling it out like that. If you did it in a, I'm just putting the units to explain the mechanism. But if you did it in like a midterm, obviously if you do it for a quiz, who cares? Because it's multiple choice. I don't know how you really, got to the right answer. But in the case of a midterm or final where you're supposed to write out the formula, I won't ask you to write, it's just because I'm explaining it this way. It's N is S divided by delta S, so it's just 800 divided by 160. But I'm just trying to explain to you that it's 5 rights per new share by showing you the units. So you have 800,000 old shares, and you always receive 1 right per one of those old shares. What changes is how many of those rights do you need to buy one of the new shares at the lower price. And that's a function of how much are you raising and what the difference between, it's a function of how much are you raising, what the current price is, and how many shares you had before. So if say you had 800,000 shares before, and you're just going to double the float out there, so you're going to do a rights offering and do 800,000 new shares, then you're going to need 1 right per 1 new share, right? If say then that the new float is 50% of what the flow of the share, what I call the float. Sorry, it's not a textbook, but it's a common finance term. The float is just the number of outstanding shares of a company. So sorry, it's not in the textbook, but I'm quite used to saying that expression. Say if you're increasing the float by 50%, so you're going from 100,000 shares to 150,000 shares, then you're going to need 2 rights to get one of the new shares. If you're increasing the float, say by 10%, then you're going to need 10 rights for one of the new shares. It's always 1 right per old share. That never changes. What changes is the amount of rights that you're going to need. It's this number, the number of rights per new share. You always get 1 per old share. That's a good question. Good clarification. Okay, so between this example and the next example, all the numbers are the same, so that I don't have to restart from the beginning. Because a rights offering type of problem usually has, it can have 3 or 4 parts. And like I said before, hint, 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 nudge, nudge. This is the great type of questions you can put as a written question on a midterm or a final. Because this is a nice kind of thing where you can have a story and then part A, B, C, D, E kind of thing. I'll show you an example that's in more examples. I don't think I'll get to it tonight, but this was a question that was on a midterm or a final like years ago, where you have a story and then it's how many new shares are going to be issued, how many rights do you need, what is the value of a right, what is the X rights price, I'll explain that in a second, and then what will the firm be worth after the rights offering. This is a nice kind of midterm multiple parts type of question. So I was at this one. So the next in the series, first you find how many new shares you're going to have. Then you find how many rights you need to buy one of those new shares. Then you find what is a right worth. So that's what this example here is. So P0, which is the market price, is 120, and PS, which is the subscription price, is 100. And then N is what I found, what I calculated in the previous example, which was 5. And so each one of the rights here is worth $3.33. Then the next thing is a little bit more on rights offering, then I'll continue the example. So rights, like I said, have an expiry date on them. Because you want to give the chance for your current shareholders to put in money if they want. But at some point, you need to wrap things up. You can't just let things, drag along forever. So you need to put, if past this day, then you can't use those rights to buy those new shares anymore. So the price of the stock will drop by the value of the right on the day that the stock no longer carries the right. Stand by under. You have that best efforts, firm commitment thing. The same with rights, and stockholders can exercise their rights or sell them. They're not hurt by the rights offering either way. Either they're given the right of first refusal and they take it, right, and they execute the transaction, and so they protect themselves against dilution, or they get compensated for the amount of dilution that they took by selling their rights to somebody else and receiving cash for it. Rights offering are quite cheap, usually because a big part of distributing securities is getting database of people and all the paperwork that goes on. But a rights offering, you just work off what your current shareholder register is. So it's a lot easier in terms of paperwork and administration than other things. So they're cheaper because there's less fees. You don't need to do things like prospectus, and because you're already public, right? You already have that apparatus, those costs in. So if you do a rights offering, it's not like, oh, now all of a sudden we got to pay an account for auditing your financial statements, which is not cheap. Like if you're doing an IPO, when you're private, you don't need to have audited financial statements. But then once you become public, now you got to do audited financial statements every year, and that's quite a bit of extra cost. But from the point of view of a rights offering, you're already public, you're already paying, the auditing, so it's not, by doing the rights offering, you're not adding these extra accounting and legal costs. So that's why rights offering are quite a bit cheaper. Bought deals are now quite common for issuing equity. So in a rights offering, there's a date of record, which is the last day that a shareholder can establish legal ownership. The stocks are sold ex-right 2 business days before the record date. Before the ex-right date, the stocks sell rights on, which means the purchaser receives the rights. Here's the idea. Think of ex-rights. Think of ex-girlfriend or ex-boyfriend. That means without, or X, when they say GDP X aircraft, that means without. So that's what that means there. X rights means that when a share goes X rights, it doesn't have that right anymore. And so the value of the share is going to drop exactly by what the value of the right is. Because before the X rights date, if you buy the share, you receive the right. After the X rights date, if you buy the share, you don't receive the right. And so after the X rights date, that share is worth less because you're not getting the right with it. You're just getting the share. And so on the X rights date, which is usually at the close, at the closing bell at 4 o'clock, whatever, for whatever time zone the stock market is in. And then exactly at that time, during the day, the people that bought the stock during the day, they will receive the right. But then exactly at 4 o'clock the next day, the people that buy the stock don't receive the right at the same time. So the value of the share drops by exactly the value of that right. And we say that the stock goes X rights. So the X rights price, continuing the series of example that I had before. So if the value of a right is so the X rights price is going going to be the price of the stock minus the value of the right. It's pretty simple. So the price of the stock's 120, and the value of the right is 333. Meaning that the X rights price is 116. The last question in the series in this type of problem in a rights offering is, what is the market value of the firm after the whole rights offering, the whole thing has been completed? So it's still the same story. You got still the same company, had 800,000, market price of 120, all that stuff. What will the firm be worth after the offering? So the value of the firm is going to be it's going to be the number of shares that you had before plus the new amount of shares. So S plus delta S, that's the, after the rights offering is completed, that's how many shares you'll have outstanding. And then the price is now the X rights price. And so you had 800,000 shares that you started with. You sold another 160,000. So afterwards you have 960,000 shares. And they're now worth the X rights price, which is 116.67, and so you get 112,003,200. So the last topic is dilution. So dilution is a loss in value for existing shareholder. Percentage ownership. Shares sold to the general public without a rights offering. Then what would happen is somebody will have, you're not taking shares away from current shareholders, but now they're going to have the same amount of shares, but it's going to be divided over more shares than before. So the percentage ownership is going to go down. Market value dilution is if you have a company that executes negative net present value projects, then the value of the company is going to go down by that amount. Remember, the whole point of finding positive net present value projects is the value of our company is going to go, if I have a project that has a net present value of 100,000 and then I do that project, then the company is going to be worth 100,000 more after I do that project. And so market value dilution is if you do negative net present value project, the value of your company is going to go down by that amount. Don't worry about that last one, book value and EPS. So let's do an example of dilution. So first we got to do a rights offering type of stuff to get to the data that we need, because before the rights offering the market price is 45. After the rights offering the market price is not going to be 40, it's going to be the X rights price, and so it's going to be 45 minus the value of a right, which is going to be 40 in a little bit, you'll see. And then what will happen to the market price of the stock? It's going to go from 45 to the X rights price. So what this question is asking is, what is the percentage decrease between the pre-rights offering market price and the after rights offering X rights price? So first we got to figure out the first three parts of of a rights offering problem. So we got 225,000 old shares, and we're selling 25,000 new shares. So that's 9 rights per share you're going to need. Then the rights price is going to be this. And so the market price is 45. The subscription price is 40. The number of rights is 9, and so that bottom part is 9 plus 1. So a rights is worth 50 cents. And so the X rights price is going to be the market price of the stock minus what a right is worth. So now we know that through this rights offering, the stock price is going to go from 45 to 44.50. So what is the percentage change between those two? So this is a symbol for delta is a symbol for change, and percent, you know what that means. This is how you do a dilution type of question. All you do is you just do the rights offering as it is, and then you just take the percentage change between the X rights price and the original market price. And so in this case, it dropped by 1.1%. And so if an investor just doesn't exercise their right and doesn't sell them, then they lose 50 cents. They lose 1% of their investment. They're compensated for that by the ability of, say, they don't want to put more money in that company. They're compensated for that dilution by having those rights. So if somebody owns, say, for each share that you owned before, you receive one right, and you can sell each one of those rights for 50 cents. And so the act of selling the rights to somebody else, that's how a current investor is compensated for the dilution of this new equity raising. Okay, so now I'm into more examples. I'll take a 5-minute break. Okay, so let's continue. These are the examples that I have. As you can see, they're mostly rights offering type of question, because this is where the besides the best effort and firm commitment, which is pretty easy, you just take whatever number of shares. If it's best effort, you take the amount that was sold. If it's firm commitment, you take the amount that was committed to. So the first part of the chapter, there's not so much substance there math-wise, but pretty much all the chapters concentrated into 15.8 on rights offering. So I have another series there where you have Toys R You. Then I have another one, dilution. We'll see how many I'm able to get to before I run out of time. I have 10 minutes, so. So the first one, the amount of new shares to be sold are going to be the funds raised by the subscription price. So you want to raise 8 million at $2 a share. So you're going to need to sell 4 million shares in your rights offering. The next one, it says the same company name, but fortunately it doesn't have the same data. So here in this case you have $5 million. It needs to be raised. Subscription price is $10, and so you will sell 500,000 new shares. And the number of rights you're going to need you got 4 million old shares. And you're going to sell 500,000 new ones. And so you need 8 rights to buy 1 new share. Buy 1 new share at $10. Next, example of the value of a right. This one actually continues, I think, the previous one. And so you know that you need 8 rights. So n is equal to 8. So the current market price is $12.50. The subscription price is $10. And you need 8 rights. And so each right is worth 28 cents. Next one. So if you want to raise $27 million, and you have the subscription price is 18, that means you're going to have to sell 1.5 million new shares. So that's the first part of the question. First thing you do. Second one is you figure out how many rights you need. So you have 8 million old shares, and you have 1.5 million new shares, meaning you need 5.33 rights. Now, this is the way it's set up in the textbook, but usually when people set up these deals, they'll set up the subscription price and the number of shares so that you have a nice round number for the number of rights. But this is just a question where you end up with a rounded number of rights, except it's not very useful. With the it could be quite confusing, you know, do you round up or down and this and that. So in the real world, when investment banks set up these deals, they'll try to come up with numbers so that the number of rights you need is, exactly 4, exactly 5, exactly 6. And so the third part is what is the rights price So each right's worth 63 cents. And then finally what we're trying to get to is what is the X rights price, which is just the rights on price, so the share with the rights on minus what the value of a right is, right? Where it drops exactly, when you look at this here, this picture, you can see this is here, this is your P0, this is your R0, and then this is your PX. So P0 drops to PX by exactly what the value of a right is. Now, I don't have too much time, so I'll skip the next example. You can try it when you're studying. It's a great example to try. And there's also the solutions in the notes, which are posted on my website and on CU Learn. I just want to do this ownership dilution question, because that one, it's really just the same as the one we just did. Right? These rights offering always have that same thing. First, find out how many new shares you need. So that's the first formula. Next, find out how many rights you need per new share. Then figuring out what is the value of the right. Then what is the exit rights price. The next one is what is the firm worth after the rights offering. In that previous example, that was not there, but that's just the number of shares you had before plus the new ones you sold times whatever the X rights price is. There was an example in the main part of the lecture. Instead, what I want to do is this ownership dilution one. So Stephen has 5,000 shares, and you want to know how is the ownership percentage going to change after the rights are exercised. Assume that Stephen, instead of exercising the rights himself, he just sells the rights to somebody else. And so how is his ownership percentage going to go down? So those are your two options when there's a rights offering, when you're the shareholder of a company that does a rights offering. You can either exercise the right and buy the new shares or sell your rights. There's a third option, which is to just let the rights expire, but that's a stupid move because you're just losing money. So in reality, there's three options, but there's only really two that make sense or that you should do. So Stephen has 5,000 shares. So his ownership afterwards is going to be, if he just sells the rights, he's going to receive cash, but he's still going to have the same number of shares that he had before. So he still has 5,000 afterwards. And we went from 1.2 million shares. We sold another 300,000 new shares through the rights offering. So now Stephen is at 0.033, which is 0.33%. So that's the purpose of a right offering. You give the right of first refusal to the current shareholders to invest in the company to maintain their percentage ownership. And if they don't want to do that, you compensate them for the loss and dilution by having them be able to sell the rights to somebody else. So that's it for today. I will see you next Tuesday, and group assignment 1 is due at the beginning of class.